The German stock market is on a tear. The DAX index, a benchmark of Germany's top 40 companies, has been hitting record highs. This surge in the DAX is remarkable. Why? Because it's happening against a backdrop of undeniable economic weakness in Germany. The country is grappling with a recession. Its economy shrank in 2023 and 2024. The contrast between a booming stock market and a struggling economy has left many investors scratching their heads. The DAX, while a useful indicator, doesn't tell the whole story of the German economy. It's heavily skewed towards large multinational companies. These companies, unlike many smaller German businesses, are less reliant on the domestic economy. They have a global footprint, deriving a significant portion of their revenues from overseas markets. The DAX paints a rosy picture of the German economy, but is it an accurate reflection of what's happening on the ground? Not quite. The DAX and the German economy are two different beasts. They don't always move in sync. The DAX is heavily weighted towards specific sectors. Manufacturing, software and technology companies make up over half of the index. These sectors are global powerhouses. They're driven by innovation and international trade. In contrast, the German economy as a whole is much more reliant on domestic consumption and traditional industries like manufacturing and construction. Government spending and public services are a big part of the German economy, but they're absent from the DAX, which focuses solely on publicly traded companies. This disconnect explains why the index can soar while the country grapples with recessionary pressures. The DAX isn't just a German story, it's a global one. The companies listed on the index are multinational powerhouses. They derive a significant chunk of their revenues from outside Germany. In fact, DAX companies make roughly 80% of their money from international markets. Think of companies like SAP, Siemens, and Volkswagen. These aren't just German brands, they're global players operating in diverse markets. This global exposure is a double-edged sword. It insulates DAX companies from some of the domestic economic woes facing Germany. When German consumers tighten their belts, these companies can still thrive thanks to strong demand from other parts of the world. On the other hand, it exposes them to risks and uncertainties in the global economy. The DAX's performance isn't a case of all boats rising with the tide. In reality, a small group of heavy hitters is doing most of the heavy lifting. These are the Magnificent Seven of the DAX: SAP, Deutsche Telekom, Allianz, Siemens AG, Siemens Energy, Munich Re, and Rheinmetall. These 7 companies have been on a tear. They've consistently outperformed the broader index. In fact, they're responsible for a whopping 98% of the DAX's total returns. Without them, the DAX would be a very different story. So what's behind the stellar performance of these 7 companies? They all share some common traits. They're global leaders in their respective industries. They've embraced innovation and technological advancements, and they've benefited from strong global demand for their products and services. The outsized influence of these Magnificent Seven has important implications for investors. While the DAX enjoys its time in the sun, the German economy is facing a perfect storm of challenges. The country is grappling with a confluence of factors that are weighing on growth and denting consumer confidence. First and foremost, Germany is in the throes of a recession. The economy shrank in 2023 and 2024, and the outlook remains uncertain. Growth forecasts for 2025 are anemic, with economists predicting a sluggish recovery at best. The housing market, once a pillar of strength, is showing signs of strain. Rising interest rates and soaring construction costs have made homeownership a distant dream for many Germans. Key industries, particularly the automotive sector, are facing their own set of challenges. The shift towards electric vehicles has disrupted traditional automakers, while competition from Chinese manufacturers is heating up. Adding to the economic woes is a sense of political uncertainty. Feeling the pinch mid and small caps struggle to keep up. While the Magnificent Seven bask in the limelight, smaller companies listed on the German stock exchange are facing a different reality. These companies, often overshadowed by their larger counterparts, are finding it increasingly difficult to attract investor attention and capital. Mid-cap and small-cap stocks, represented by the MDAX and SDAX indices respectively, have underperformed significantly compared to their larger counterparts. This underperformance is not just a short-term trend but has been a persistent issue over the past few years. The MDAX, for instance, tumbled by 5.71% in 2024. This decline has raised concerns among investors about the long-term viability of mid-cap stocks in the current economic climate. The SDAX, meanwhile, experienced a more modest decline of 1.78%. Although less severe, this drop still highlights the challenges faced by smaller companies in maintaining their market positions. These figures stand in stark contrast to the DAX's impressive gains, highlighting the uneven nature of the German stock market's performance. The disparity underscores the growing divide between large multinational corporations and smaller, more localized businesses. Unlike the global giants that dominate the DAX, these smaller companies tend to be more domestically focused. Their success is closely tied to the health of the German economy, making them more vulnerable to local economic fluctuations. They rely heavily on the German economy for their revenues and are therefore more susceptible to the headwinds buffeting the country. Economic challenges such as slow growth, inflation, and regulatory changes can have a more pronounced impact on these companies. The weakness in the housing market, for example, has had a disproportionate impact on construction companies and building material suppliers. This sector's struggles are a microcosm of the broader issues facing mid- and small-cap stocks in Germany. Is the DAX undervalued? A look at the numbers reveals some interesting insights. The DAX's resilience amid economic uncertainty has sparked a debate among investors. Is the index overvalued, or is it an overlooked pocket of value in a turbulent market? This question is more relevant now than ever. One widely used metric is the price-to-earnings or PE ratio. This ratio compares a company's stock price to its earnings per share, providing a snapshot of how much investors are willing to pay for each dollar of profit. It's a crucial indicator for assessing market value. As of today, January 21, 2025, the DAX is trading at a PE ratio of 15.7. This is significantly lower than the S&P 500, the benchmark index for the US stock market, which currently boasts a PE ratio of 25.2. This stark difference raises questions about market perceptions and potential opportunities. On the surface, this suggests that the DAX might be undervalued relative to the S&P 500. However, it's crucial to consider the context. The broader economic environment plays a significant role in these valuations. The German economy, as we've discussed, is facing significant headwinds, which could weigh on corporate earnings growth in the coming years. Investors must weigh these factors carefully when considering the true value of the DAX. What's next for the DAX? Navigating uncertainty in 2025. As we gaze into the crystal ball of the financial markets, predicting the future of the DAX is no easy feat. The landscape is filled with both opportunities and challenges that could shape the index in unexpected ways. The index faces a confluence of tailwinds and headwinds that make forecasting its trajectory a complex endeavor. Economic indicators, global events, and market sentiment all play crucial roles in this intricate dance. On the positive side, the DAX benefits from the strength of its constituent companies. These firms are leaders in their respective industries, driving innovation and growth. The Magnificent Seven, with their global reach and innovative prowess, are well positioned to navigate the challenges ahead. Their ability to adapt and thrive in changing conditions is a significant advantage. Moreover, the DAX's relatively low valuation compared to other major indices could attract bargain-hunting investors, providing a potential source of support. This could lead to increased investment and stability. However, the German economy's woes cast a long shadow over the market. Economic stagnation and declining industrial output are significant concerns. The ongoing recession, coupled with structural challenges in key industries like automotive, will likely weigh on corporate earnings growth in the near term. This could dampen investor confidence and market performance. Furthermore, geopolitical uncertainties, including the war in Ukraine and rising tensions in the Asia-Pacific region, add another layer of complexity to the outlook. These factors could lead to increased volatility and risk. Navigating this uncertain terrain requires a nuanced approach. Investors and analysts must stay vigilant, adapting their strategies to the ever-changing landscape to find opportunities and mitigate risks. Conclusion: a market of contrasts. The German stock market in 2025 presents a fascinating paradox. On the one hand, the DAX index is hitting record highs, fueled by the success of its global giants. On the other hand, the broader German economy is grappling with a recession, weighed down by domestic challenges and structural headwinds. This divergence between the stock market and the real economy highlights the importance of looking beyond the headlines. Understanding the nuances of the DAX's composition, the global reach of its constituent companies, and the challenges facing the German economy is crucial for investors seeking to navigate this complex landscape. As we move forward, uncertainty will likely remain a defining feature of the German market. However, amid this uncertainty lies opportunity. By focusing on individual company fundamentals, tracking macroeconomic developments, and maintaining a long-term perspective, investors can potentially find value and outperform in this market of contrasts.